This is Deepa Sachanandani, and in today's webinar, we'll be talking about how to invest in the global markets during the crisis. So, as we're all aware, we have the Russia-Ukraine crisis that are currently on. And before we begin, our heart and sympathy goes out to all the ones who are dealing with these crises, and we're just hoping for the situation to get better. There are many individuals out there who are suffering. We have students from India who are locked in out there. So we're just hoping for the situation to get better. But as financial analysts, we also look at the situation from how the markets are dealing and reacting to the current market crisis. And this is what we will be targeting in today's session. We'll try and understand what are the current market opportunities, or how do you manage your risk while you are investing in the markets. So, and before we get started, I would just like to know, do we, most of us, are we already invested in markets, or do we have a great understanding of the markets? So, if some of you can just respond, if you have a beginner level idea about what's happening in the markets, or if you are highly involved in the markets and are advanced and are trading to a great extent. So if we can just have a quick response like beginner, moderate, or advanced, so then I can accordingly tailor the session throughout. So if some of you can just respond, it would be great. So okay, fine, perfect. So we have some who are already into markets, and while some who are not really trading. So accordingly, I'll tailor the session to ensure that it is a mixed session, and everybody who's a part of it can eventually learn and make something out of the session. So, moving on, before we start as to what's happening currently in the markets, it's important that we understand what was the global scenario as the year started, or what was the world dealing with. So, as we are all aware, inflation has skyrocketed. In the United States, the inflation is close to almost 8% now. So it's at a 4 decades high. So even at the start of the year, the world was grappling with inflation. So what happened was, back in 2020, because of the pandemic, central banks across the world had pumped in a lot of money in order to ensure that the economies and can survive and fight out the pandemic. So what happened when there's so much money pumped into the system? Eventually, inflation did shoot up to the sky. We had supply disruptions and other issues. So inflation is trading at a 4 decades high, at a 40-year high. So what is happening when inflation is at a 40-year high? Central banks across the world, they want to try and control the inflation. And what we will be seeing going forward is a tighter monetary regime across the globe. Central banks across the globe have been talking about, controlling the inflation. And how do they do that? The central banks would try and reduce the money supply in the economy, and that's how they will be controlling the inflation. One of the easiest measures that is generally used by the central banks, is when they will start increasing the interest rates. So back in 2020, we saw the US and the central banks across the globe, they deducted and drastically slashed down the interest rates and the borrowing cost. But now we will see the central banks will start increasing the rates going forward in a way to tackle the inflation. What happens is that when you end up increasing the rates, consumers will be enticed to save more rather than spend. And when there is less money chasing the goods, automatically inflation will also come under control. That's how the cycle works. So the US has already started with its first rate hike. We'll be discussing about that going forward. But right now, this is how the background is. And when inflation is high and the central banks are going to increase the interest rates, we will gradually see a slowdown in the growth rate, and that is what is projected by the IMF and all the central banks across the world. So this is just the base case scenario. Now, moving forward as to what can we expect in with regards to the Russia-Ukraine crisis, what is revolving and what is happening when it comes to the Russia-Ukraine crisis. So, the Russian invasion of Ukraine, which started on the 24th of February, has kicked off policy actions and moves across the global market. We've seen the Russian ruble has reached an all-time low. It's close to, I mean, it in fact went down to as low as 118. It has recovered a bit, but that's the low that it reached against the US dollar. And the Russian equity market has remained closed since February 25th. The deadline was until today. We don't know if the markets will open on Monday, but the indices were suspended till 18th of March. We need to see what happens going forward. During the crisis, we saw oil prices shot up to the roof. It surged over 139, I believe, is the high for Brent, and this was the highest since 2008. Gasoline prices have also skyrocketed. Not only oil prices, other commodity prices, palladium, iron ore, aluminium, wheat, corn, all have gone to record highs. And why did this happen? We'll come across that also in the slide ahead. Major reason being is that Russia is a major exporter of all of these commodities, and the sanctions on Russia contributed to that. So let's understand what were the kind of sanctions that were imposed on Russia. So firstly and foremost, like I said, on 8th March, we had the US President Biden, who signed an executive order to ban oil imports from Russia. Then we also had the United Kingdom, which said that they pledged that gradually over time they will phase out their oil imports from Russia. Going forward, even the European Union, which is heavily dependent on the Russian oil imports, they have also decided that they will try and curtail their imports from Russia going forward. So that has been the major sanction that has been imposed on Russia. But we have sanctions coming across from the US, Canada, the United States, Japan, Australia, and so on. And these sanctions have been on the banks and even on exports of high assets such as the tech and so on. So across the space, we've seen a lot of sanctions being imposed, especially on banks. There were some banks were removed from the SWIFT financial mechanism, and that has also been levied on Russia. We've seen because of which almost 600 billion of foreign currency reserves were impacted by the moves carried forward by United States and other nations, and because of which we even saw the Russian banks the Russian central bank raised their interest rate from 9.5% to 20%. So these are all the sanctions that were implemented from the rest of the world on Russia. But coming on to the major question as what will be the implication of all of this on the markets and on overall the macro economy. What are we expecting? Obviously, given the fact that we saw that inflation has gone up to the roof because of the surge in commodity prices. So yes, Russia's invasion of Ukraine will slow down the growth and raise inflation forecasts everywhere. And because of the surging inflation, global central banks will have to enact and probably increase their rates at a faster pace, which is also a cause of worry. At the same time, I mean, markets have been falling. So central banks, especially the United States, is at a tricky situation right now, and the Fed policymakers have a tricky a decision to make. On one hand, they're dealing with surging inflation. On the other hand, they're dealing with the scare that the market participants are going through because of the crisis. So yes, it's a tricky situation for the central banks out there. So we will see some impact in the near term on the markets. We've already seen a lot of impact. We'll be talking about that. Now, moving forward, uh, so why will this impact be felt? Just a key point to add over here. So Russia basically accounts for almost 10% of the global oil and natural gas production. So if you have sanctions on Russia, obviously, with the demand for oil increasing, given the world is reopening up, we will face a huge crisis, and oil prices did shoot up to the roof. As I mentioned, it rallied to as high as over $130 a barrel before correcting again. Now, there have the reason why we saw some pullback in oil prices was because of talks between U.S. and Iran, and then we had other OPEC nations, especially like UAE, came forward stating that OPEC should increase the oil supply to handle this situation. So we'll see as to how the situation develops and what happens going forward. But the biggest scare for markets right now is the surging inflation. Then, when it comes to the impact on the other nations, for example the United States or the companies within the United States, we are not expecting the earnings to take a major hit because of these current prices. Of course, the energy shock, like I was speaking about, is a concern, and we will see how that develops going forward. But in terms of the earnings from United States, from the major corporates in the United States, we won't be seeing a major hit out there. But when it comes to the European central banks, which have a major exposure to Russia and even to the domestic Russian banks, yes, we will see a lot of impact over there because obviously there has been so many sanctions, and the banks in the Europe, which have a major exposure to Russia, will also face those issues. So, moving on. So, looking like I was stating, United States will face limited impact. The major impact will be on Europe, and that will be the most exposed. Obviously, Russia, that goes without saying, is the most exposed. And when it comes to commodities and metals, we've seen they've really done amazingly well this year, and nations which are deriving their revenue from commodities. For example, indices such as South Africa, we have Canada, they have been doing well. We'll be talking about each of these in the slides ahead. So I'll take it up over there. Moving forward, so like I was saying, why have commodity prices gone up to the roof? The reason behind this is that if you can see on this slide out here as well, Russia basically contributes to 42% of the global exports. Wheat, I mean, almost 21%. Ukraine contributes to 10% of the global exports. So the number is huge for these companies. Look at palladium. Palladium is at 43%. We have platinum 14%. We have nickel 11%. We have aluminium. So I don't think it was until these crises occurred that the world realized that how much Russia is actually contributing to the global economy in terms of exports. And only because of this, we saw a huge surge in commodity prices. on Wednesday, we had Ukraine's president who came out and said that the position of Russia and Ukraine seems to be sounding more realistic, but more time was needed, is what he stated. Russia's foreign minister said that deals with Ukraine were close to being agreed. This is what was said on Wednesday. However, the situation again changed, and I don't think we are still out of the woods, and we need to be dealing with the same. Um, Sorry about that. Yes, so when it the latest updates coming out of Russia, what we saw was there were some more missiles that was struck in an area near the airport on Ukraine's western city of Lviv on Friday. Then we also currently what we are seeing is that markets are attaching a very low probability for a ceasefire between Russia and Ukraine, especially given the fact that there has been a amount of sanctions on Russia day by day. So currently, previously markets were hoping for a resolution, but now that situation seems to be changing. If in fact President Putin has outrightly acknowledged that the war could intensify further, given the fact that the Western nations have been supporting, Ukraine with further weapon aids. So the situation keeps changing a day to day. So there is no clear message out there. But from what I can see, from what we've seen in the markets, the worst seems to be behind us. Markets seem to be have taken the Russia-Ukraine situation. Like we did see a big fall in major markets across the globe, but there has been a rebound in markets, and we'll see that in the slides ahead. So. Just one more point out here, which I would really like to add. According to United States, they've recently come up with a statement just today itself. They've stated that Putin is likely to make further nuclear threats if the war drags on. So this is obviously a cause of concern, and if this accelerates further, we'll see. A major pullback in markets if this happens. Now, whatever I say out here and going forward, whatever we discuss, please understand that this is a macro view, and everything will, what kind of investments need to be made and how do you need to invest in the markets, all of that will depend on your risk appetite, your if you're already invested in the markets, the kind of exposure that you already have to a particular sector. And so it's very important that you discuss with your investment consultants before we take any decisions. So yeah, whatever is said out here, it's very important that we have a discussion with our investment consultants before we move forward. So so far we've covered a lot. I just wanted to confirm if y'all can see the slide on or no, because I think there is a problem. I cannot see the slide on my screen. So if someone can confirm if they can see the slide or no. I cannot see the screen on my screen. On my, can you just send someone over here? Yeah. All right. So, I mean, for some reason, on my system, I cannot see the screen. But if you all can, what you can see on the screen is highlights from the U.S. Federal Reserve meeting. If someone can just give me a thumbs up, because most of you all can see the screen. So, if you can see highlights from the U.S. Federal Reserve meeting, can anybody just once again respond with a thumbs up? All right, great, perfect. So before we take a look going forward as to how the markets and the indices and commodities have performed this year, it's very important that apart from Russia, Ukraine, we also focus on the highlights from the latest U.S. Federal Reserve meeting that happened on Wednesday. Right. So as we all know, I mean, I don't know if you all are tracking, the U.S. Federal Reserve has increased the interest rates by 25 basis point, and this was the first increase since December 2018. Along with the rate hikes, they've also stated that going forward, they would be taking aggressive steps and increasing the rates by almost 6 times in the year ahead, bringing the net interest, the federal funds rate, to 1.9% by the end of the year. So this number is almost 1 percentage higher than what was expected in December. Okay. Now, the committee is also seeing going forward that the GDP will come down from 4%. They are expecting the GDP to come down to 2.8% in the year ahead. So this is what is expected by the markets. But in this situation, when the Federal Reserve is increasing the interest rates, and when they are saying that going forward there will be further rate hikes, and they're saying that the GDP will come down. In such a situation, ideally, you would have expected the SPX to, or the major US benchmark indices to fall, and the equities to fall, because normally stock markets do not like the raise in rates. But what we will see and what we are expecting, we actually saw the SPX rallied in the last 3 days. What we were discussing about was the fact that the US central bank has gone ahead and increased its benchmark interest rate by 25 basis points for the first time since 2018. Not only that, they've also signaled that going forward there'll be 6 more rate hikes in the year ahead and bring up the benchmark interest rate to 1.9%. Now, historically, when interest rates go up, that is not a very positive situation for the stock market, because what happens is that ideally, when you were investing in the debt markets, for example, or when you're parking your funds in the savings account, the lower the interest rates, the more enticed are you to invest in the equity markets. As and when the interest rates start going up and higher, because equities are considered risky, we see that the funds flow out from the equity markets to the safer fixed deposits and the savings deposits. So generally, when interest rates go up, it's considered as a very negative situation for the equity markets, also because it increases the borrowing cost for the companies, and thereby impacting their profitability. So that is the general trend and the general scenario that is expected. But did this actually happen once the Federal Reserve increased the interest rates? What happened? We saw the S&P 500 actually climbed up by 3% since the US Federal Reserve has increased the interest rates. So why did this happen? Well, the answer to this question is that firstly, markets react well in advance. So most of the negative news was priced in. Markets knew and were expecting the Federal Reserve to increase the rates by 25 basis points. They were also expecting the further rate hikes that the US Federal Reserve has mentioned. And because they were already expecting this, and the Fed stuck with its plan and did not go any further and any beyond, that was in fact viewed positively by the markets, and the S&P shot up along with the other indices like the Nasdaq and so on and so forth. So all the stocks actually rallied after the US Federal Reserve increased the interest rates. And the reason, like I said, markets tend to react well in advance. What markets don't like is a lot of uncertainty. So before the FOMC meeting, there was a lot of uncertainty as to what is going to happen next. So whenever there's uncertainty, we'll see there's a pullback in stocks when for example, even when it comes to the Russia Ukraine crisis. So there's a lot of uncertainty out there that what will happen next. So markets do not like uncertainty, and generally, whenever there is this kind of uncertainty, we see a pullback. And ideally, a rate hike should have been negative for the markets. But the minute there was clarity and there was certainty as to what's happening next, we actually saw a pull, a rally in the indices. So this is what happened. Now, if I were to show you what has happened for the how have the indices across the globe performed so far this year, so that will help you all understand and get a picture as to which countries outperformed and which did not, and what were the reasons behind the same. So as we can see, most indices, especially we start with the United States. So we have the SPX, we have the NASDAQ. So these indices are trading at a discount from and not only their 52-week high, but year to date, NASDAQ has lost almost 13%. So when interest rates go up, technology stocks generally are considered to be more aggressive and the riskier ones. So when interest rates go up, the risky stocks tend to take a beating much more than the safer stocks. That has been the trend in the past. So we saw that in the year since Jan, Nasdaq is down by 13% at one point in time. In fact, it was down by 20% from its all-time high. So like I said, markets reacted well in advance. Even before the rate hikes happened, investors had already predicted that this is going to happen going forward. And so there was already a pullback in the SPX, NASDAQ, Russell, and so on and so forth. Now, across the globe, when it comes to Europe, obviously, because of the ongoing crisis in Russia, like we discussed previously, also the most impacted would be the European nations, and therefore it is trading at a 10% discount this year. From its all-time high, it's trading at, from the recent 52-week high, it is trading at a 12% discount, so on and so forth. You have France, you have Germany, Spain. Most of these indices are trading lower. Now, let's talk about which index is trading in the green, or it's at least not really losing money. So we have the UK 100, that is, and we have the Canadian index. Now, these two indices are actually have not lost this year. The reason being, so Canada has a lot of energy-based companies, and because this year oil prices have risen dramatically. We've all seen that. We'll be seeing that on the next slide. Because of that, we've seen the Canadian index do well. Now, UK 100 consists of, again, energy in energy stocks as well, but it also focuses on value based companies. Now, during volatile times like these, we tend to see value stocks will outperform. Will most likely we see them that value stocks have outperformed growth stocks. This is what has happened historically, and logically also it makes more sense. So when interest rates are expected to climb, value tend to outperform growth stocks. So this is what was even seen for UK 100 and Canada. Also South Africa, another index that has done well because it almost the top two companies which contribute, not the top two, but they contribute almost 25% to the index. Now, these companies primarily derive their revenues from the sale of iron ore, copper, palladium, and so on and so forth. So, because of that, again, because these commodity prices shot to the roof, uh, these indices did gain. So that is what was the performance. Now, when it comes to China and Hong Kong, there have been a lot of issues out there. we saw the Chinese and the Hong Kong indices fall drastically, also because of the regulatory sanctions that have been happening, so on and so forth in China. But there were recently a lot of positive updates coming out from China, where China has pledged to reduce these regulatory sanctions. So that was viewed really positively by the markets, and we also because of the surge in COVID cases in China, we had seen some pullback in the indices, which was also probably the dip was found as a buying opportunity, and the indices have recovered. So if you can see, the low from the 52-week high was like almost 21%, and currently it's trading at 14%. So, and for Hong Kong, the low was 27%. I mean, from its 52-week high, it's trading at a discount of almost 27%. So, yes, that has been the pullback in Hong Kong and Chinese indices, but definitely they have rebounded on hopes that going forward the regulatory sanctions will be much lesser. So moving on to the different sectors that have done well without any surprises, the energy sector has done amazingly this year when it comes to S&P 500. The reason why we're showing this slide is so that it will enable you to understand which sectors have done well so far this year, and what could be the investment opportunities and which sectors you can look forward if the situation that we saw in the recent past continues for the foreseeable future. So obviously, if we see the crisis escalate further, and if there is no solution coming for oil prices, then we do see oil prices going up further. In fact, JP Morgan has predicted the average oil price to remain at $110 a barrel this year. So I mean, and that's the base case scenario. The risks are skewed to upside, even according to them. So if the situation does escalate, and there are no increases in supply coming out from uh, the OPEC members, then oil prices could scale up further, and if that happens, the energy sector will most likely outperform. And like we were saying, in such a situation where it is a crisis-like situation, or also whenever there's a kind of uncertainty in the markets, or when markets are fearing a slowdown or things like that, the sectors that tend to do well are utilities or consumer staples or healthcare, because these are stocks that that no matter what shape the economy is, you will always need to invest in the basic utilities. You will always your healthcare demand will never drop down even if there's a recession. So these companies tend to do well, because they give dividends. So during these situations, we see these companies generally tend to do well. These sectors tend to do well. Now, when interest rates go up, we'll see the financial sector, that is the banking sector, also tends to do well, because obviously they will be lending at a higher rate, so, and they lend long term, so, and borrow short term rates are currently low, and they'll be lending at higher rates. So obviously it is profitable for the banking sector out there. So this is in terms of the sectors. Now, moving forward, when it comes to commodities, now for commodities, like I said, palladium actually rally has gained almost 32% this year. It went up to as high as 3442. Currently, it is at 2,500. So. There was a massive volatility when it comes to commodities this year. You can see the same thing for aluminium. Currently it's at 3380, still trading at a 21% high this year, whereas the all-time high was 4090. So on and so forth. Gold prices actually went up to 2070 before correcting further. So the last that we've seen, gold was trading close to 1940 or 1930. That's the level. The reason why gold actually went up to such levels was gold is generally considered as a safe haven asset by the investors and the markets. So whenever we have a war-like situation, gold is considered as the go-to asset. So any kind of financial crisis in the past that we've seen, generally you'll see gold prices go up to the roof. And the reason for the pullback can be considered as, I mean, the markets have started looking past the Russia-Ukraine crisis. Like I said, markets generally tend to react in advance. So even before the war had started, just when the news came out, there was a drastic drop and a drastic fall in major indices. So, and at the same time, gold prices also shot up. So markets are very quick to react, and because of all of that, now they are looking past these crises, which is why we've seen gold stabilize around these levels. uh, what will happen going forward, we shall discuss that as well. Give me a minute, sorry. Yes. Yeah, and like we can see for Brent and WTI, obviously the gains have been phenomenal. They are up by almost 37% this year. Gasoline prices are up by 44%. Wheat is up by 42%. And we've seen all of this in the slide earlier, wherein I was talking about how Russia contributes nearly almost 40% of the aluminium is exported from Russia, so on and so forth. Even wheat, almost 20% comes from Russia, 10% comes from Ukraine. So, given the supply disruptions, it is obviously a no brainer to see commodity prices go up to the roof. In case if you all have any questions during the presentation, or if there's something that you don't understand, you're always welcome to interrupt me and ask me, and I will try and cater to those questions either during while I'm speaking, or maybe towards the end of the session. But any questions, please do ask. So yes. Now, when it comes to currencies and treasuries, obviously the dollar, which is considered as a safe haven currency, did see some gains this year. It was one of the strongest currencies, and comparatively, we had the euro currency, as well as the Japanese yen and the GBP. All of these did suffer some losses, while the dollar outperformed. Now, again, the reason being, whenever we have these crises or war-like situations, the go-to currency is the dollar, because obviously the United States is the superpower. So that is what we saw happen in the start of this year as well, especially in the month of Feb. And when it comes to current treasuries as well, the long-term treasuries, generally, whenever interest rates go up, treasury prices fall. They are inversely correlated. So if you have to understand the fundamentals about the same, we can do it in a separate session. I can explain the logic behind the same, but just a thumb rule: whenever the yields go up, you'll see the bond prices fall. So the United States Ultra and the German Buxel and the Eurozone, basically, the treasuries did witness a pullback. They were trading almost 10% lower this year. So this was the overall gist of what has happened so far this year. Now, the key question, and the obviously the reason why you all are here is what do we do next? Should we invest in the markets, or how do we go ahead? So this is what we will be catering to in the session ahead. So far, if you have any doubts or any questions, feel free to write in the chat box, and I'll take it up from there. So if there's anything, please feel free. All right. So, so while we keep receiving questions, until then, I will continue and take it forward and look as to what are the opportunities that we have in in these markets, and should we be investing or no? So that brings up to this key slide where we will be catering and we'll be looking at how markets have reacted historically and in the past whenever we've seen such geopolitical pullbacks. So what we've seen is that these pullbacks generally tend to be short term in nature. I mean, obviously they do bring sudden crashes, like we've seen. The war and conflicts have brought these sudden crashes, and that can be in varying degrees depending upon the kind of the crisis that the world is facing. We generally do see a pullback and a sudden crash, but the recovery is also relatively solid and forecastable. This is what has happened in the past, and this is what we've seen. Of course, there have been exceptions to this rule, but if you can see how the markets have performed during each of these crises, so there has been a drawdown of, on an average, close to 5%. This is the average. Of course, the worst has been close to 20%. Which happened during the Pearl Harbor attack in 1941. We saw a drawdown of almost 20%, like you can see over here. But what happens in the year ahead is more important. So if you or anybody would have invested during these dips, then the average return 1 year later would have been 14%. And like you see, the probability of these gains are much more. So bearing the US 9/11 terrorist attacks and a few other areas, the Hungarian crisis, wherein the markets did not recover in the next 12 months. But all the other areas, if the dips were bought, it would have been a good investment opportunity back then. So 3 months later, the markets were up by almost 8%, 6 months later by 10%, and a year later, they were up by 12%. So yes, the sell-offs tend to have a duration of close to around 3 weeks. That is what we've seen historically. And going forward, the returns in, if the dip is bought, have been phenomenal, as can be seen. This is what history has stated. I mean, this is what we can see in the what has happened in the past. And obviously, it makes more logical sense also, because when there is a war, like I was stating earlier, markets do not like uncertainty. So obviously, there is a lot of uncertainty in the markets when there is a crisis or a situation like this. But when you think about, have the fundamentals of a company changed, or have the fundamentals of that particular industry change, then most likely the answer may be not. Obviously, it could be impacted, like in this case, by the rising energy prices. So yes, we can see an impact over there. But otherwise, for example, United States is generally the region in which the crises are on is the one which will suffer. For example, Russia, yes, will suffer to a great extent, and we will see a significant equity loss. But when it comes to regions which are isolated and far from Russia, so for example, United States, will that index suffer for a prolonged basis because of the Russia-Ukraine crisis? Well, the answer will most likely be a no. So, keeping that in mind, this could be a good investment opportunity, but obviously from a long term perspective. If you're looking at investing in the markets and you require the funds in the next 2 to 3 months, then I would say a complete no, that this is not an investment time. But if you're looking to invest in the markets from the long term perspective, yes, the current pullback can be considered as an opportunity. But should you go all out? No. We have a strategy in place as to how we can invest? Yes, we do. We'll be discussing that in the slides ahead. Now, this chart over here talks about how the S&P 500 has performed in the month of in each of the months. And as you all can see, the month of April has been really bullish for the index. Out of the last 15 years, it has rallied almost every month in, every year in the month of April. So, what we generally see is that stocks tend to bottom out towards the latter half of March. And there are various reasons that are responsible for this. One of the major reasons being is the tax filing happens in the US in the month of March. So we see a lot of portfolio rebalancing and shuffling that takes place by the mutual funds in the month of March ahead of April. So that could be one of the reasons why indices tend, especially the SPX 500, tends to do well. Also, this for example, the latter half of March, we are seeing literally there would be, it's called as quadruple witching, wherein four contracts, for example, you have the options on stocks, then you have the options on indices, then you have the stock futures, and most of these are expiring almost on the same day. So when that is happening, there's a lot of volatility in the markets, and because of that, traders would either prefer to close their positions in order to avoid that volatility. And that's why we see that generally towards the latter half of March and especially April, there is a pickup in the indices. Again, this is no hard and fast rule. Just because something has happened in the past, there's no guarantee it will happen in the future. But when we are taking these decisions, and if the fundamentals are also in favor, then a chart like this certainly will increase your confidence much more before investing in the markets. Now, one more interesting statistical fact, which is actually working in the favor of the bulls and who are looking to invest in the markets, is the fact that as you are all aware, I don't know if you are aware about this, but S&P actually entered in to a correction recently. A correction is something when the index falls by more than 10% from its high. So SPX did do that, and now obviously it has recovered from the low. But whenever that happens, what happens in the year ahead is that the index is generally 25% higher in the next year, with an average, with the probability being 90%. So when I say 25% higher, that is obviously the average, and it is not a fixed number. So in some years it can be less than 25, in some years it can be more than 25. But this is what has happened historically. And 2 years later, the index on an average is 37% higher, with the probability being almost 87%. So, yes, these numbers are in our favor. And should you be investing in the current markets? Again, the answer will be very personal, and it will depend upon your current situation. If you're already invested in the markets heavily, then I may not recommend the same. But if you're looking at opportunities, and if you've invested partially, this could be the next entry dip that you can invest in. So historically, that we've seen that, if you're investing in markets, but if you look at investing during the dips, then obviously there has been a significant outperformance if you look for dips and increase your investments further during dips. But this is only if you have the patience and you are disciplined and focused when it comes to your investments. Okay, so what is the kind of investment that we can look forward to in these kind of markets? So, well, we what Century has been pitching, and I believe it's an amazing strategy to go forward, especially in these markets when the markets are so volatile, is a ladder-based or a pyramid-based investments, wherein we will be investing in phases. So allow me to just share the screen once, 1 second. Yeah. Well, yes. So I'm hoping you all can see the screen. So this is the ladder portfolio that I was talking about. So, as y'all can see, basically in this portfolio, we in the phase one, we'll be investing only 20%. In phase two, we'll be investing 35%. And in phase three, we'll be going for another 45%. Now, what we will be investing is also important, and we will be looking at that in the slide ahead. So before I talk about each of these components over here, let's understand what are the different kind of sectors and that we will be investing in. Obviously, as we all know that the world has opened up and recovered, so we'll be focusing on a mix of technology as well as reopening stocks. Now, when it comes to technology names are generally more aggressive, so we'll be looking for sorry, just a second. Can someone please confirm if they can see the screen that I'm sharing with the aggressive, moderate, and the investment style, ladder based investment style? Right. So we were talking about this ladder and investment style portfolio. Now, in this case, what we'll be doing. So, for example, if there's someone who wants to now this the investments will depend on person to person. If you want to go for 1 million, 100,000, 500,000, that is entirely your call. But this is just for an example for you to understand how to invest in the current market scenario. So, for example, if we have a $1 million investment that we are looking at, and in the phase one, we'd be looking at 20% investment. So what happens is that, like I was saying, the world has already reopened up, but at the same time, we hear cases of COVID on and off. So when that is happening, we are looking at a mix of uh, technology as well as reopening stocks. When it comes to technology, the kind of stocks that we have catered to in this portfolio, we can see names like Adobe, we can see Tesla, Amazon, Airbnb, Salesforce. So now when you see at Airbnb is a technology stock, but at the same time, it is also a reopening stock. So as and when the economy is open and as and when people travel, obviously the demand for Airbnb should also go higher, and that will be a positive for the stock, which is why it is a part of the portfolio. Now, coming on to the segregation and to give you an explanation as to how we have phased out the investments across different sectors, for example, aggressive, moderate, and conservative. Now, the reason we've done that is that in a situation like this, wherein the markets are so volatile, it's important that your investments are diversified across different kind of stocks. So, if you were to go all out for aggressive stocks in the current market situation, and if we witness a further pullback in the markets, or if there's a war-like situation, then we can see a drastic fall in our equity value, which is why it is important that we segregate and manage our risk, and we are invested between aggressive, moderate, and conservative stocks as well. Gradually over time, for example, in the second level, when there's a dip, at that time, we will start increasing our exposure towards aggressive and moderate stocks and slightly reduce our exposure to conservative stocks. And in the third level, like you can see over here, we'll have the least allocation to conservative stocks, because hopefully by that time, when the third dip comes into the market, that would be the time that most of the correction has taken place, and then we would start investing up from there, more in aggressive and moderate stocks. Sorry, just a second. So the reason being is that initially, when we are investing in the markets at the current levels, obviously there is no clarity what will happen going forward. So it's important that you look at a mix of more of conservative stocks in your portfolio. So, like I was stating earlier, PNG, Walmart, Coca-Cola, CVS Health, these are companies that investors, I mean, the end user will require even on a day-to-day basis, the products from these companies. And so during volatile times, we do not see stocks like these witness a major pullback. In fact, they can much more outperform the aggressive stocks in case if there's a lot of volatility in the markets. So yes, we can focus on investing in stocks like these. Then we also have gradually, as and when the markets will start recover, we will start and increase our exposure towards the aggressive names. So in this portfolio, although we see, I'm saying that these are aggressive names, most of these are quality. Most, in fact, all of these, we've stuck to only quality companies. The intention is that when markets are falling, in such situations, when there is a lot of uncertainty, when interest rates are going to go up higher, it's very important that you invest in quality names to avoid any kind of major risk in your portfolio. And also, another big suggestion that I would like to give is that at such times, taking leverage is probably a no. Leverage means investing with borrowed funds. So you need to invest in the markets, one, with a long term perspective, and two, with your own money and without taking leverage. So the more the leverage you take, the more the riskier it gets. And we, at these times, taking risk is a no. Looking for short term and quick returns is something everyone likes, but if you're looking at a no risk situation, then it has to be phased out in a proper manner so as to avoid the major risk. So if you have $1 million and if you're looking to invest in the markets, we'd be investing 20% in the phase one, that is 200,000, of which our aggressive will have 30%. So out of this 200,000, only 60,000 will go to aggressive stocks. Then we'll have only 70,000 go to moderate stocks, and the remaining 70,000 will go to conservative stocks. So on a net basis, if you were to see the portfolio, out of the across all the phases, we'll have 40% going to aggressive, again almost 40% going to moderate, and 20% going to conservative stocks, wherein the maximum investment in conservative stocks will happen during the phase one. So I understand that this could get a little complicated for you all to understand. In case if you have any questions regarding the same, please feel free to ask, and so I can explain it further. All right. Someone's asked me to zoom in, so I'll do that once again. Is all right. If you can see this over here, what we'll be doing is out of the 1 million, for example, in the first phase, we'll be investing 20%, which is 200,000. Out of this 200,000, only 30%, which is close to 60,000, will be going for aggressive names, because currently the volatility in the markets is high, so the risk could be high. 70% will be allocated to moderate stocks. When I talk about moderate stocks, we have names like JP Morgan, Bank of America, Starbucks, Walt Disney, ExxonMobil. ExxonMobil is an oil company, so with oil prices rising, there's a good chance that this company will also do well. Starbucks is a play, again, a reopening play. Banking stocks are tend to do well when the economy is opening up and when the interest rates are going up, and which is why they are a part of the portfolio. Then in the moderate, we've also considered the US indices, which include SPX, Nasdaq, and Russell. So 70,000 will be allocated across these seven instruments, and this is the kind of investment that you need to make across each of this. The total amounts have also been mentioned. In case if you are looking at a much smaller amount and you want us to devise a portfolio for you separately, that can always be done. You can reach out to us or to your RMs, and that the revised portfolio will be made for you. That is not an issue. This is just a standard portfolio across the board for all clients who are big ticket clients and are looking for this kind of investments. But if you are looking at smaller denominations, that is also completely fine. We can devise that portfolio for you. Coming back, we'll out of the 200,000, for example, the remaining 35% will go to conservative stocks, and these include names like Coca-Cola, Walmart, Procter and Gamble, Verizon. These are companies that tend to be less volatile during the crisis that we are seeing, or whenever there's a recession or a rate hike situation that is happening. But like I said, markets have reacted well in advance. Most of the negative news seems to be priced in, and which is why we feel the current dip in the markets can be a good entry opportunity. Obviously, not going all out, keeping the money for the other phases as well. So in the second phase, for example, we'll have more investments at the second phase and the maximum investment in case if there is a third dip that we witness in the markets. If there is no dip that comes in, and if we do not see this kind of a fall back, I think we should be happy that our phases that were done in our investments that were done in phase one and phase two were profitable. These are markets where obviously you need to be a little greedy, but at the same time, we cannot be catching a falling knife, and our investments have to be sensibly made. So, which is why we've kept a maximum proportion for the third phase. But even if that doesn't come, I think we need to be glad that we entered the markets during the first two phases itself. One thing that we've seen is that everybody wants to try and catch the exact dip, but you have to understand that that's not happening, and that's not possible. In Nobody can catch the exact dip. You can obviously get lucky once or twice, but trying to time the markets is very difficult. And what happens, and what we've seen historically, is that when we are trying to catch the exact dip, you end up missing out on multiple opportunities. We know of so many clients who missed out investing in the markets during the 2020 fall that we saw in March 2020. We had portfolios and again webinars that were conducted back then, wherein we had devised a plan as to how you can start investing, and if that would have been taken, many clients obviously would have made significant amount of money if invested back then. So it's very important that we start investing, and of course, like I said, whatever I'm saying over here, it has to be discussed with your investment consultants and accordingly, because obviously the kind of risk that you can take and the kind of situation that you are into will differ from person to person. So please get in touch with your investment consultants we before you take any further decisions. Now, right. So. This is how the ladder portfolio is. We also have another, in case if you have any questions on these, please feel free to ask, but you can always go through this. We have an explanation on each of these stocks as to why they are good investments. Some of them are dividend paying stocks, which will also help you right through the volatile times. And like I said, these are all quality names. You don't have to fear that even if the stock price is falling drastically, that kind of fear will not be there that what if the company goes out of business. So yes, these are the kind of stocks we've included in the portfolio. Apart from that, we also have a ladder based portfolio for indices. I shall share that as well with you. um, all right. Just like we were investing in the individual stocks. This is a ladder-based portfolio for indices because many clients obviously feel it easier and more convenient to directly invest in one particular index rather than investing in so many stocks. And most importantly, in the current situation that we are into, handpicking stocks and selecting which company will do well is a little tricky, and many some clients may not be comfortable with that. And keeping that in mind, we've devised another portfolio which is talking about ladder-based investments. Yet again, a pyramid style of investing for indices. So this is the logic and the idea behind the portfolio is exactly the same as we saw for the a stocks based portfolio. We will be investing in indices in phases. Again, the first phase will be 20%, the second phase will be 35, and the fourth phase will be 45%. Now the key question is, what are the kind of indices that we will invest in? Which countries do these indices belong to? So, like I have discussed during the entire presentation and um, during the entire session, we've been talking as to why it is important to invest in United States, because obviously the impact on the companies within the US from the Russia-Ukraine crisis will be much minimal. And US is a major superpower and accounts for 50% of the total market capitalization. So obviously, given the kind of strength that we've seen in United States, it makes sense to have a major chunk of your investments in the US. And obviously, we are not going all out right now, so it will only be a partial investment right now in United States. And the three indices that we'll be looking at will be the S&P 500, the Nasdaq, and the Russell 2000. Now, S&P 500 consists of the 500 largest companies of the United States, and it is considered as the benchmark global index. So, yes, it's considered to be relatively moderate. When it comes to Nasdaq 100, it comprises majorly of technology stocks, and it is generally more volatile. So, our investments to technology upfront will be limited. So as you can see out here in the first phase, we will not be investing much in the S&P 500, or in the Nasdaq 100, sorry, and our total investment will only be 15.6%. In the S&P 500, in the first phase, we'll be investing 4% in, and when I say 4%, it is out of our total exposure. So we will be investing only 4% in the first phase. In NASDAQ, we'll be investing only 2.5%. In the small cap companies, again, small cap companies have given a decent dip and are trading from its 52-week high, it's trading at almost 16% low. So considering that, a small portion and a small proportion can be allocated to these small cap companies, but from a long term perspective, we will increase further only when we see further dips. That is, we'll gradually increase to 4.4 and 6.8% when there is a further dip of almost 10% during the phase three. So on and so forth. We can even see for Nasdaq, because it's an aggressive technology-based index. Upfront, our investment will be limited, and when it increases, when there are further dips, we'll increase our investments. So in the first phase, we'll have 9% that is going that will be allocated to United States. When it comes to other countries, we'll have 11%. Now, as we've seen previously, Canada is one index which has benefited from the surge in energy prices. So after the S&P 500, the maximum weightage is to FTSE, UK 100, and Canada, because like we discussed, UK 100 is a value-based index, while Canada is benefiting from the surging energy prices. And gradually, accordingly, we keep increasing our exposure more to aggressive indices and reduce our exposure to conservative indices. Talking about amongst the European, we have just two indices that we've selected. One is France 40 and the other one is Netherlands. Now, France 40 comprises of many global brands and companies in their portfolio. It has brands like LVMH in its portfolio, I mean, in its index, and which is why it is a part of our portfolio despite the pullback and the crisis in the European markets. And when it comes to, like I said, France 40 is generally the companies within the index are more representation of what is happening in the global economy, and they cater to the global economy and not just to the European sector, which is why it is a part of our portfolio. And when it comes to Netherlands, it mainly comprises of semiconductor companies and stocks, and we've all seen how semiconductor stocks have rallied dramatically in the last year, and this has been because of the growing demand for the chips and semiconductors. Today, whatever we use, be it the laptops, our iPhones, our TV screens, our electric vehicles, almost everywhere we have semiconductors. So the use for semiconductors and the demand has grown multifold, especially after the pandemic, where everybody has been so dependent on technology. So we see this demand will gradually increase in the year ahead, and which is why we've included Netherlands as well in our portfolio. So again, each of these indices, we have given an explanation. You can read it out in case if you have any queries. We can speak over it personally, or in a separate session. We can do a separate session just on these, so that can also be done. And lastly, if we were to talk about the other possible opportunity that we can invest in, just give me a minute. I'll share the presentation once again. Okay, so I have a question from someone. What about day trading opportunities? Well, yes, there are many trading opportunities that are available in the markets, and we can analyze what these opportunities are depending upon the technical levels. So we have various opportunities, especially with the kind of news that is being rolled out on a day-to-day basis in terms of oil prices. We see a lot of movement happening. So sorry, one second. Yeah, so we have a lot of consultants who are available to provide with the just a second, so sorry. Right. So what I was talking about is that we have multiple opportunities when there is news about the movement in oil prices or anything of that sort. We can invest, and we can track the movement in the prices. So, for example, if we have at the technical levels that we monitor, we have the RSI, we have the moving day average. So there are various levels, the support and the resistance levels that we watch out for. And depending upon the situation, we can accordingly invest in the markets, especially in commodities. There has been a lot of movement. But again, when we are doing that, it's very important that you keep a stop loss, because markets these days are very extremely volatile. So it's very important that you keep a stop loss. Now, this is a day trading opportunity, but we also have a lot of opportunities that are happening in the markets right now when it comes to spread trading. So I will be talking about that in the next slide. So, for example, when we were seeing the fluctuations in gold and dollar, there was a lot of arbitrage opportunities that were available in the markets. So we saw. Basically, these were market neutral strategies that were available in the markets. So just hold on to a second while I share that slide and screen with you. Right. So these are called as market neutral strategies. What we do is that we try and invest in similar in instruments that are correlated with one another, and when we try and look out for the spread between the two instruments. So as you can see in this in on this slide, I'm talking about Brent and WTI. Now, Brent is basically the heavy crude oil that we all know, and then we have the WTI, which is the light crude oil. Now, generally, on an average, the spread between these two commodities, when I say the spread, that means the price difference between Brent and crude, is generally historically seen to be around 5 to 6, with the highest being $10 in the last 1 year, and the lowest being almost recently the low was $1 as well. So when we have these differences, and when there is a difference way above the average. So for example, recently when the price had dipped to one, the spread between these two commodities, it was a good trading opportunity wherein you buy Brent and sell WTI at the same time. So we are not playing on the fact that will prices go up or go down. We are just hoping for the spread to come back to the historical average of close to 4 or 6, and that is what exactly happened when recently on 16th Feb 2022 the spread between these two commodities was $1, and when the spread increased to $4, we could see profits of almost $16,000 being made on a $1 million on a 500K exposure if you're taking two times leverage. So what we are trying to these are when we say market neutral strategies, what it basically means is that you are immune to the movement in the markets. You're just looking at the spread to increase. So be whether WTI goes up or goes down, it doesn't matter whether oil prices go up or down. What we are interested is just in the spread. So this is an amazing trading opportunity in markets like these, wherein we don't know what to invest in, and what will be the next move in the markets, what will be the next announcement, and how will the prices react. So this is one investment opportunity. Then we saw, so this is the chart for the same. Like you can see, it was the lowest that we've seen was last year when it was close to $0, and recently it went up to as high as $6. So if someone would have exited at $6, the profits would have been close to $28,000, based on investments of almost 500,000 on each side. So this is what was. These are the kind of opportunities that are available. Again, it's important that you get in touch with your respective consultants before you invest in these ideas. Now, another idea that we see, and we were expecting this idea to come across much before, when the news of these crises in Russia and Ukraine had started, and we had already started speaking about this strategy with our clients. And most of our clients were well prepared to take the trade, because these opportunities are available just for a small span of time, and it's important you're quick to act on them. So what we saw was, we have something called as a gold cash contract, something called as a gold futures contract. Now, futures contracts are something wherein it's you're agreeing, when we say a futures contract, it's basically you're agreeing to buy a commodity or an instrument at a future date, but you're entering into a contract right now. The price is being decided right now. You will agree the price as on today's date, as to when you'll buy in the future. So the way the futures price is calculated is based on the cash price plus the holding rate. For example, if you are not investing in the commodity right now, you will park the money elsewhere and probably deposit those funds. So the kind of interest rate that you would have received, depending on that rate, the futures prices are decided. This is just a very basic example of how a futures contract or a futures price is decided. So what we saw was that when there were sanctions imposed on Russia, investors were fearing that there won't be. I mean, the spread between gold cash and gold futures contract shot up drastically, and it went up to as high as $6. And generally, the spread is less than $1 also between the cash and the next contract. Generally, we see the price difference is hardly anything. So if you would have undertaken this trade, and if when the spread actually came down to much below, almost zero point 0.5 or zero point 0.8. So in that situation, the kind of profits that would have been made would have been close to $2,400. Even for a silver spot futures, the similar trade was available, wherein and the spread was almost as high as 52 cents between the silver cash contract and the silver May contract. And if the trades were taken back then, I've seen the spread come down to 26, even much below than that currently. If and when the spread comes down to zero, the kind of profits would have been almost 11,000. So that is what were the opportunities that were available in these kinds of markets, and that is what you can be on the lookout for. But when we are taking these trades, you have to ensure that uh, these are without leverage, and of course you have to get in touch with your consultants, understand the kind of risk and that would be available for these trades, and only then take the trade. So yes, these were the different opportunities. This is how we can go ahead. We can be on the lookout for these opportunities, and they keep coming on and off. Currently Brent and WTI spread is back up to 3.5. So if we witness a pullback again wherein the prices are close to $2, then we can take the trade. Or if the spread shoots up to $8-9, then again that would be an entry to take the reverse trade. So this is there are multiple opportunities available in the markets. Depending upon the situation, we can gradually consider and alter the kind of investments that we need to make. So yes, that was it from our end for today's session. If you have any questions, please do ask. Apologies for the kind of disturbances that we had today, technical glitches. So apologies for that. But otherwise, we hope that the session was informative. You can always review us on Google and give your feedback. If you have any other questions, I'm here. You can please ask. All right. So I think. Yes, certainly. The webinar will be available on. We will be sharing the video for the same, so you can definitely look at the webinar once again. Yes, these the ladder portfolio, those slides will be those flyers can be emailed to you, or you can get in touch with the respective RMs, and they will drop in the email to you for all the flyers and the presentation that was discussed. You can have all of that. All right, then. Thank you so much. It was lovely doing the session for you all. I hope it was informative, and looking forward to seeing you all again. Thank you once again.